Welcome to The Alternative Investor. In the past, all hedge funds were unregulated and they could not be marketed to the general public, and only institutional investors had access to them. In 2015, however, hedge funds were declared to be collective investment schemes, and as such, they were drawn within the ambit of the Collective Investment Schemes Control Act, becoming regulated financial products for the first time. To help us explore South Africa's hedge fund industry, we're joined by Jean Pierre Verster, who's the CEO of Protea Capital Management. Jean Pierre, thank you so much for your time.
Thanks, Anastasia. Good to be with you.
So, hedge funds sound complicated, so perhaps you could help us understand what they're designed to do.
So a hedge fund is basically a fund that utilizes leverage, which means there's an element of borrowing. And the term hedge fund is not homogeneous. So different hedge funds do different things. But the most common hedge fund is an equity long-short hedge fund, which means a fund that buys shares that it expects to rise in price and shorts shares that the hedge fund manager thinks could fall in price. And through that process, a hedge fund tries to make money both from rising shares and from falling share prices.
Right. From your experience in the industry, what would you say about South Africa's hedge fund industry?
It's still a relatively small industry. As per your introduction, it used to be unregulated. And the fact that it is regulated now means that the public can have confidence in investing in hedge funds. But it is still a recently new phenomenon, the fact that hedge funds are regulated. Internationally, hedge funds aren't regulated. And that means that quite often hedge funds don't have the best of reputations, but that's mostly because of the offshore hedge funds that are not regulated. In South Africa, now that hedge funds are regulated, it's quite exciting for investors to consider it as an investment option because, as you would know, the last 5 years have seen very low returns on the JSE. A lot of shares have fallen in price, and hedge funds can take advantage of that and actually make money from falling share prices.
So who would a hedge fund be designed for? What kind of investor are we looking at, particularly, let's talk from an income perspective?
So you get two types of hedge funds in the regulatory environment: retail hedge funds, which is basically for the general public, the retail public, and qualified investor hedge funds. Now, a qualified investor hedge fund has got a minimum investment value of 1 million rand. So it's actually only for high net worth individuals or for institutions. I'll focus on the retail hedge fund market. And there, once again, a retail hedge fund does various things. Some of them operate in income markets, as you refer to, also known as fixed income markets, and they try to generate income. But the majority of retail hedge funds do operate in equity markets. So they don't necessarily focus on income. Rather, they focus on capital growth over the long term. And therefore, hedge funds in general are not short-term funds to invest in today and maybe disinvest tomorrow, but rather to invest and keep it for the long term.
We often talk about fees when it comes to the investment space. What do the fees look like in the hedge fund side?
Traditionally, hedge funds utilize performance fees, which means that if the hedge fund performs well, the fees will be above average. And if the hedge fund does not perform above average, the fees also won't be above average. What the performance fee methodology means is a fund that does really well will charge a very high fee. Normally, it's about 20% of the profits. But even after that fee, the investor still gets an above average outcome. So a lot of the criticism regarding the high fees that hedge funds charge focus on those hedge funds that have ironically done the best. On average, though, hedge funds can be seen as a higher fee type of investment, but it is justified by higher returns and the fact that that fee is only charged on performance. And therefore, if a hedge fund and a hedge fund manager doesn't perform, they can't charge the performance fee.
Let's look at the funds that you manage. Going into COVID, how did they perform and how have they performed since then?
So we've got three hedge funds: the Protea South Africa Fund, which focuses on South Africa; the Protea Global Fund, which focuses on markets outside of South Africa; and the Protea Worldwide Flexible Fund, which invests both in South Africa and offshore. And what we saw coming into COVID is that our South Africa fund also had a negative return for March and April. So one shouldn't expect the hedge fund will always give you a positive return. It can also have negative months. And since then, the fund has rebounded. On the global side, we've done particularly well. We had a lot of technology stocks that we were long in our global fund, and we were short some oil and gas shares, especially in the US, which fell a lot because of the lower oil price. And that means that particularly the Protea Global Fund has done very well and is up after fees by roughly 24% year to date. So that's the fund that has done particularly well, notwithstanding the COVID impact.
Right. So for someone who's considering investing in a hedge fund, what are some of the questions they should be asking the hedge fund manager?
So because they are regulated products now, anyone can Google the term hedge fund. There'll be a list of hedge fund managers and their websites. You can go on their websites and you can download the fact sheets. The fact sheets should answer most of your questions, and it has all the details regarding what the fund does, the fees being charged, and the historical track record. And I think that's quite important. You want to invest with a fund manager that has shown that they've got skill. It isn't just based on luck. And therefore, the past track record is important. And if you would ask questions to a hedge fund manager, it should be regarding the investment process, so that you can gain comfort that the process that is followed, while might not lead to a positive return every single month, over the long term can lead to an investment return that is above average.
Jean Pierre, thank you so much for your time this afternoon. That's Jean Pierre Verster, who's the CEO of Protea Capital Management. Well, we'll have more news with my colleague Nzinga Kunta at the top of the hour. Your weather details are up next, and I'll be back tomorrow with Books on Point. Goodbye.